what we're seeing is a market that's surprisingly strong with all the geopolitical noise, whether it's in Europe, in the US, tariffs and so on. Absolute levels are almost at historical tights. We see spread levels both in Europe and the US really, can't get much better. But what we are seeing is that investors are becoming ever so slightly more selective. All the deals that we did, and there was 10 billion of supply yesterday, went well. But we saw a really significant amount of attrition as we went through, revising the pricing. So, we went from, Schneider having a 11 billion order book to, in some of the, tranches that weren't performing so well, more than halving, right? So investors are saying, I'm still comfortable, but, there is a sort of limit. And we really went there yesterday.
You've seen this before. You've been around long enough that you understand how the market dynamics work. Kind of what signal do I take away from that? Is this just we're really tight and I'm getting kind of a bit more selective, or is there something bigger here that we need to be paying attention to?
So what's clearly evident is that investors are a little bit nervous about the levels, but at the same time, whether you look into the investment grade market or the high yield market, there's a lot of cash around. So obviously investors need to invest that. But what's very clear is if there would be negative news that would be more substantial than the geopolitical noise.
Give me examples of that kind of news.
So when we had non-farm payrolls in late July, obviously they were disappointing, and then the previous three non-farm payroll data were lowered in terms of what was reported before. The market got worried that that our biggest fear might happen, which is tariffs are going to be negative for the global economy, that the U.S. might go into a recession, which is right now not the base assumption. But we are also relatively early in the whole tariff game. Companies don't really know how to behave. It seems to change every other day what's going to happen. So the real impact hasn't been seen yet. So if we would see a material impact on U.S. consumption, on the economy tailing off further, I think we'd see a real change. Keep in mind, spread levels are about 50 basis points tighter than they were in early April when the tariffs were announced the first time. That's the kind of variance that you're playing with at the moment. And obviously investors are somewhat concerned about that.
So the argument for why perhaps there's this element of resilience or corporate resilience in the States, but arguably in Europe as well, is that there's a lot of liquidity and cash left over from a lot of the record issuance we saw in 2020 and 2021 specifically here in Europe. When it comes to financing conditions, how much of that is kind of the playbook you're seeing from corporates, i.e., if you're expecting more volatility and you're expecting Fed rate cuts and you're expecting more tariff risk, it's better to raise money now to build up that cushion. Is that the thinking?
Absolutely. When you look at what happened in the first half of the year or until now, we are now 4% ahead of last year in terms of issuance volumes. If you look at the dollar, euro, and sterling market, we're about flat for the dollar, but we're about 13% ahead for the euro market. As we have gone through the year, we hit this big hiatus in April. Spreads went wider. Corporates were, okay, I need to see what all this means. They came back pretty quickly, and people were really worried. And you saw a massive wave of issuance in in May, June, and July. And I think we are going to continue with that narrative. Think about the bank sector. Banks are pretty much done with their funding program, for the year. What we're seeing right now is them already going into the market saying, well, who knows how the next 6, 9, 12 months are going to be. I'm just going to continue with my program. When the market is good, I'm going to hit it.
You just did a deal with Schneider Electric that I've heard has gone very well. There is an argument that we've had in the last couple of days from credit guests who are saying that because of the sticky fiscal situation, a lot of the fund flows, as Guy was pointing out, are coming to the corporate credit space as an alternative to that. If that's the case, how low can spreads go? And are you seeing that being reflected in some of the corporate deals like Schneider?
Yeah, so if you look at the Schneider deal, what was interesting, the largest demand was at the sort of at each end of the 4-tranche deal that we did, so at the short end and at the long end. What was particularly interesting was French insurance companies were massive in the 12-year for Schneider, a deal that we priced 10 basis points inside French govies, right? So it's very clear that a globally diversified A-rated names like Schneider Electric, Siemens, the like, that's exactly what people are saying. If I am a little bit worried, especially in the short term of what might happen, that's probably a safer bet. So I'm willing to, pay very aggressive prices on that.
Schneider, a French company, is a better bet than the French government.
Well, in the short term, I guess that's what people are saying. Yes.
And is that does that make sense? Is that a view of the future, Matthias, or the near term at least? Given that post-pandemic, a lot of guests have told us, companies came out of that with pretty decent balance sheets. Governments came out of that without good balance sheets. So that it would make sense maybe that companies can borrow at a cheaper rate than a government.
Yeah, I mean, I guess the long-term theory of the risk-free rate being displayed in govie yields and there being a premium for corporates, I think will still hold. Right. I do think that there are certain corporates that don't come often, that have an incredible, track record of performance, that it might happen. I do think for the general market that theory will still hold.
Talk to me about the role of the private market, because I'm interested when we talk about corporate debt markets being at record tights, and that's obviously comparing it with its own history. But is the public market now what it used to be? Because haven't a lot of names that maybe make it more difficult to borrow just gone to the private markets instead? And so comparing the public market with its own history maybe is a bit more difficult these days?
So the private market certainly is a huge theme. It was obviously initially something that was really dominant in the high yield market, but we're seeing it more and more also, somehow applying itself on the investment grade side. Private credit ultimately, sells itself to its own investors for getting a premium relative to the public market. So if you're a public market issuer and you have great access and your story is good, I think you will still go for the public side. But somebody that needs a little bit more of a tailored solution, that maybe has ratings pressure, certain, huge investments where you might want to have them off balance sheet first and bring them back on, I think they are starting to realize that the sheer volume that is available is obviously an option, and it's right to, look at all the options that you have and then decide what's best for you.
You talk to a lot of companies and you talk to a lot of investors. What is their expectation currently of what the tariff narrative is going to look like? Because it feels like over the last few days we've come back to this idea that maybe the impact isn't going to be so great. You smile at me. Is that where your head is? Is that where the people you talk to's head is?
I don't know where my head is, but I think that the investor's mindset is clearly that while there will be an impact, we are facing potentially an economic slowdown in the U.S., but I think people are not worried about a real recession. Ultimately, the way I think about tariffs is you have a 10% base layer that obviously they apply to pretty much everybody, and then they have additional ones with certain sectors in certain countries. So right now, add all that up, you're sort of 14, 15%. So the question is, how is that going to be swallowed, right? Is there, at what pace can price increases to the U.S. consumer be pushed through? Clearly not something that the U.S. government wants to see, but obviously something companies will try. Or how can companies, balance out their supply chain over time to swallow all of that? And it seems to be that the market is saying somehow what we're seeing right now is that we can sort of sail, through it, maybe at a slower pace, but it's all going to be fine. The question is if that's true.
Do you think it's all going to be fine?
Well, I'm a bit worried, and I think people should take advantage of markets that are pricing in all the good news.
Can we talk about another risk? And going back to Anna's point on private credit, there's an argument for the private credit bulls in the room or in the world that the deals that are creating this private credit boom are insulated and not going to create systemic risk if something goes wrong. From your vantage point, if something does go wrong in the private credit space, if you see a surge of defaults, is there contagion into investment grade, high grade, et cetera?
We're not worried about that in the investment grade space for sure. The question is, at the moment, the numbers sound large, in terms of private credit, but there's still, a relatively small portion of the total market. Obviously, that will continue to grow. But as I said before, the question really is whether If the narrative for private credit funds is that they're going to produce a premium to what public market funds are producing, then for companies, the cheapest source of funding is still the public market, right? Yeah. So it's always going to be for those companies that need something special, and I think there's a space for it. The question is, how much is that? I'm not going to put percentages on it, but it's going to be a portion of the market. It has a space for it. Is it going to be so large that it causes a systemic problem? I think we'll have to watch it clearly, but it's not something we're worried about at the moment.